Hello, welcome to today's lesson. Today we are going to be talking about Fibonacci retracement, premium and discount, and most importantly, how to combine them correctly to read the charts. By the end of this video, you understand where you should anticipate your pullback to look for entry and how to stop chasing the market and waiting for the market to come to your level that you can take trades. What is Fibonacci retracement? Fibonacci retracement is a technical analysis tool used to identify potential pullback level. We want to identify the levels that your pullback will get to so that you can take a trade and continue in the trending direction. Fibonacci is used on a trending market. You don't use Fibonacci on a ranging market. So the Fibonacci tool helps us identify potential pullback levels. That's area where price may pause, react, or continue its trend. Market doesn't move in a straight line. It moves in a wavy form. And remember when we talked about market structure, we said as a trader, there are 3 questions you have to answer. Where is market coming from? Where is market now? And where is price going? And you can view that directional movement through market structure. Applying Fibonacci to it will help you understand how to take advantage of the pullback when it happens. So it's not magic, it's not prediction, it's just you following structure, adding the tool, the Fibonacci tool, premium and discount to help you take informed decisions in the market. Key Fibonacci retracement level. The most commonly used levels are the 23.6 levels, the 38.2 level, 50% level, though not a Fibonacci number. It's the average, the middle part of a 100% movement. That's why 50 is brought in. The 61.8%, the 78.6%, and we also have the 70% and also the 88.6%. We're going to talk more on those levels when we get to premium and discount. So this Fibonacci retracement tools is potentially a support and resistance zone marking tool. Remember when we talked about support and resistance, we said we have static support and resistance and we have dynamic support and resistance. The dynamic support and resistance is more of a tool-based support and resistance flow. So Fibonacci tool is one of the tools we use to draw up those levels of support and resistance in the market. How Fibonacci retracement works in trading. Number 1, it helps you identify potential support and resistance level. In an uptrend, the Fibonacci level often acts as support. When the market is trending down, your pullback is definitely going to go the up way, where you're going to look for resistance to continue selling to the downside. So in a downtrend, the Fibonacci level acts as resistance. So instead of guessing where price might react, the Fibonacci gives you this structural zone. It marks out the zone to help you see clearly where price might react when it is pulling back. It also helps you time your entries. It helps you time entries. It improves your entry timing. You should be able to know where to buy, where to place your stop loss, and also where not to buy and not buying too early into the move. It will help you, give you that breakdown of where you should anticipate your entry, not entering too late or too early, and it also helps improve your risk analysis. Fibonacci works perfectly with market structure. You have to combine market structure before you use the Fibonacci. Without a structural movement in the market where you have higher highs and higher lows for a bullish market, lower lows and lower highs for a bearish market where you keep having break of structure. At every point of structure being broken, in the example we did in market structure, this is a bullish market structure where we're having the market go up, down, moving in a wavy form. So your Fibonacci is drawn on the impulsive leg. The impulsive leg to anticipate your pullback level to take trade back to the upside. So if you don't have a very good structural movement in the market where you have your higher highs and higher lows for a bullish market, the Fibonacci is not used in a ranging market. You only use the Fibonacci when you've gotten a structural movement in the market that will give you an opportunity to anticipate your pullback level. When you draw the Fibonacci on an impulsive move, it gives you levels, divides it into two. First level, it gives you the 38 point here, it gives you the 20 something point some percent here, 61.8. These other levels come down. So you anticipate the move to have a reaction on any of these levels that is acting as support for a push back to the upside. So that's what Fibonacci helps you do. It works best when the market is trending. How to draw Fibonacci? In an uptrend, you have to identify the swing high and your swing low, a clear identification of that swing high and swing low. And you don't just draw it like that. You need to, if the once the market moves like this, giving us a break of structure here, we get a BOS here, break of structure to the upside, get a BOS. This low point here is your swing low, and this level here is your swing high. At every point where the market moves, gives you a pullback, what we use Fibonacci for is to time where this pullback you are anticipating should give you a good level where you can find entry and go to the upside. So once that happens and we get another break of this swing high, we've gotten a new swing low here and a new swing high at this point. So this is not relevant for us to use on our Fibonacci. The Fibonacci will now be used on this new impulsive leg. So as long as the market keeps breaking, pulling back, breaking previous high level, we keep using the Fibonacci will now be used on this new impulsive leg. We keep moving the Fibonacci, plotting new support and resistance level where we should anticipate our pullback to get to and take the advantage of going the bullish direction. Peradventure price comes down and breaks this last higher low. It tells us that we have gotten a shift into market structure where we should start looking for price to start going back down. But as long as price is moving and it is not taking out the previous low point here, we are still on our bullish movement and we keep using our Fibonacci as price progresses. The reverse is the case for bearish. How to use the bearish, how to draw the Fibonacci, use it correctly. So for a bullish market, you draw the Fibonacci from the low point to the high point. For a bearish market, you draw the Fibonacci from the high point, swing high to the swing low. We'll practicalize this when we get to the charts. So in a downtrend, you identify a clear swing high, clear swing low, and we draw the Fibonacci from the high to the low. From the high to the low. For a downtrend, from the high to the low, you draw the Fibonacci. For an uptrend, from the low to the high. An uptrend is when the market is moving in a bullish market structure, and you have to draw the Fibonacci from the low to the high. It's going to plot the lines here for you. Then for a bearish market where price is going down, you draw the Fibonacci from the high to the low. It's going to plot the levels here for you to use as your pullback targets to continue in your bearish direction. Price is expected to retrace upward to the Fibonacci level to continue downward. That's for a bearish market movement. So understanding premium and discount. Premium and discount are concepts used to help traders know whether a price is expensive or cheap relative to the recent price movement. And they are most commonly used in market structure and Fibonacci retracement. So we are going to remodify our Fibonacci a bit in order to play along with the premium and discount concept in trading. This is where trading starts to make real sense for you. If you understand premium and discount, it will help you answer the question, is price cheap or expensive right now? It should also help you know where to buy and where to sell at a particular point. So what is premium? Premium means The price is expensive relative to its recent bearish movement. Premium is an area where price is considered expensive relative to a recent bearish movement. If price has moved in a bearish flow like this, you're not supposed to continue selling here. You have to wait for price to do a pullback. So let's mark out what premium and discount really means in a price movement. So if market has done a bullish movement like this, giving us a new swing low here and a new swing high here, breaking structure at this point. Let me label it for us to see it properly. If we get a break of structure here, this is our swing low and this is our swing high. If we divide this movement into 50%, this is where the 50% of the Fibonacci comes in. This top part is called the premium area, premium zone, and this down part is called discount. This down part is called the discount zone. So in a bullish market structure like we are seeing here, you wait for price, you always anticipate your pullbacks to come into discount, which is telling you when you go to the store to get a product and they give you that product at a discounted price, it means that they're giving you at a lower price, below a price lower than its original price where you should have purchased it. So the price moving up to this point is a high price. So you have to wait for a discounted price for price to come back down below 50%. Below 50% is called the discount zone. It's telling us that it's less expensive now. It's cheap for us to buy. So when you use the Fibonacci plotted at this, Fibonacci is going to give you levels below 50%. So with the modification of premium and discount on the Fibonacci, we are going to be taking out some of the Fibonacci number like the 23.6 and the 38.2 levels, which are above 50%. So we want all the percentages that are below 50% to be utilized on the Fibonacci when we are looking at premium and discount using the Fibonacci tool also. So now for a bullish market, we'll have to wait for price to get into a discounted price, a cheap price. Remember, price has gone up all this way and we have to wait for it to pull back down so that it can give us an advantage price that is cheaper for us to buy back into the move. Price comes back and takes out this high. It gives us a new swing high here and a new swing low here. We do the same thing, divide this into 2. We still get our premium zone up here and our discount zone up here. So we wait for price to do another pullback into discount, give us an advantage point aligning with the Fibonacci line here for us to take advantage and move to the upside again. As long as price keeps taking out the highs, we move our Fibonacci to this new impulsive leg, giving us a new swing high and a swing low here. This is divided into 2. We get the discount here and the premium here. So at every bullish movement, we want to utilize the discount zone. For bullish movement, we want price to pull back into discount to give us a cheaper price for us to buy. Then for a bearish movement to the downside, applying the swing high and swing low principle. This is a swing high and this is a swing low. We draw the Fibonacci. Remember, this is 50%. This is our premium zone. This is our premium zone. Premium zone. And this is our discount zone. For a bearish market, we want to see a pullback into premium because it is an expensive price for us to sell whatever product we have to the downside. For bullish movement, we want our pullback to get into discount, giving us a cheaper price from the swing high for us to take advantage and buy back to the upside. For a bearish movement, price has gotten this cheap, so we want price to can't sell our product at this point. Its price is very cheap. We want to pull back to an advantage point for us to take trade at the premium zone downward. As price keeps breaking the level, it gives us a new swing high and a new swing low. divide it into two. We have our premium zone here and we have our discount zone here. We do the same thing. We have the patience and wait for price to move back into premium zone to give us an advantage to take trades to the downside. We keep following this flow until there's a break of structural movement to the upside. Then we now apply our Fibonacci, same here. For upward movement, we have to wait for price to come into discount to give us an advantage to go to the upside. The same thing gives us a new swing leg, 50%, pull back into discount for movement to the upside. This cycle continues as long as we have a market structural movement to the upside or the downside. So for bullish movement, we have to see price move into discount for us to take advantage and push price back to the upside. For bearish movement, we have to wait for price to pull back into premium zone to push price to the downside. So how premium and discounts are identified, like I've drawn, we have to identify the market direction. We have to make sure that we are in a proper market trend of uptrend and downtrend. So for uptrend, we look for buying opportunity, and those buying opportunity in an uptrend, we have to wait for price to pull back into discount zone to push back to the upside. For downtrend, we have to look for selling opportunity, and we look for selling opportunity at premium zone. So we identify the recent swing highs and swing lows. We draw our Fibonacci retracements. We define our premium and discount zone depending on the trend we are in, and we wait for market to pull back into it to take advantage from there. Before we modify our Fibonacci, let's look at it at its default stage. We are using the MetaTrader 4. You can use the TradingView and any other platform you can use, but we're using the MetaTrader 4. Let me just take this back to default, property, back to default. Okay, now taking this back to default, when you draw it, remember we said Fibonacci has to be used on a trending market. If we want to mark out this market movement, we'll see that price came all the way down, went up, came back down, and we had a move to the upside, showing us a practical break of these previous highs. Market did a pullback, went back up again, then another pullback, went up, did a little pullback here, went up, pulled back, went all the way high, pulled back, high, pulled back. So structurally, this price is a bullish market move, and we've gotten a break of this last higher low that gave us this high here. So using the Fibonacci on this, you see at default, the Fibonacci, since it's a bullish market, we mark from high to low, from low to high, sorry. At default, we'll have the different percentages like we mentioned. We have the 23.6, we have the 38.6, 50%, 61.8. Remember we said in a bullish market, we want to buy at discount, and discount are those zones that are below 50%. So we are going to modify the Fibonacci to take out these other percentages that are above 50, because it's not going to be useful for us if we are waiting for price to get into the discount zone. It's not that price cannot move down and take advantage of this or take advantage of this price level. It can, but for following rules and structural movement, we want to see our pullback get into cheaper price, which is discount, to look for opportunity to buy to the upside. So modifying the Fibonacci here, going to double click on this red dotted line here, this red dotted line, then the 2 dots will come up, 3 dots, then you right click on the line to bring out the drop box of the Fibonacci. Then you impute those other percentages that are below 50. So we have this 78.6, 786, which is going to be our 78.6 level. And we also have the 88 88.6. Sixth level. This is going to be our 88.6. We also have the 70% level, 71% level, 0.771. 6, going to be at 71.6. So once we do that, we say okay. So you see, the Fibonacci has been remodified. We are not having those figures above 50%. We are having it below 50%, giving us levels where we should anticipate price movement. Anything from 50% down to 88.6 and not going below 100 are good levels at cheaper price where we can take advantage of price movement to the upside. And one of the confirmations we can wait for is to look for price movement that will take us into the level where we get confirmation from candlestick pattern, lower time frame structural shift, and also confluences with moving average that will confluence at any of this level for price to move to the upside. So looking at the movement, price moved up, broke this point, pulled back into the discount zone, found the 78.6 level, bounced, took out this high. Here we got a break of structure. After getting the break of structure, what we'll do next is to move our Fibonacci to the next impulsive move, which is this point. To this point, price pulled back into 50%, a good level also to start looking for opportunity to buy. Move back and broke this high. So we move our Fibonacci to the next impulsive move, which is this high to this low point. Price almost got to the 50%, but it didn't get there. It moved up. We got a pullback, not into discount. Then we got a break. So we now move our Fibonacci. As long as we keep getting those breaks, our Fibonacci will now be moved to the next impulsive move. The pullback happened and it came back down into discount. So as long as price keeps giving us this structural movement, we keep moving our Fibonacci to give us opportunity to enter at an advantage point at a cheaper price if the market is bullish at discount or the move back to the upside. The reverse is the case for a bearish move, for a bearish movement. So we get a bearish movement. We look for the same thing, break of structure. If we use this level, price move down here, pushed up, came back and broke this previous low. So we pick our Fibonacci tool. Remember, this is bearish. We are measuring from up, down. Price pulled back to the 50%, came back, broke structure here, giving us a new low. So we move our Fibonacci to the next impulsive leg, which is this low, and this will drop from this point. Price pulled back into premium and pushed, breaking this low point. So as long as price keeps giving us those structural movement, we keep following and moving our Fibonacci to the next impulsive leg to map out our structural movement and wait for a pullback if it is bearish into premium, and wait for a pullback if it is bullish into discount to take advantage of what price has for us. So buying and selling logic, like I've explained, for premium and discount in an uptrend, the buying logic is that in an uptrend, price moves up, pulls back, you wait for price to enter the discount zone. Look for confirmation, is very important. A break of structure on the lower time frame, candlestick pattern, or a rejection. Then we buy in discount zone. So the higher time frame is very important for you to look for this structural movement and apply your Fibonacci, because it's going to reduce the noise and also give you an advantage to go to the lower time frame and look for this confirmation when price gets to this discount zone for a buying logic. So when you spot a level on the daily time frame or 4 hours time frame, you go over to the 1 hour, 30 minutes, 15 minutes and look at how market is reacting at those zones so that I can take advantage from them. When we get to the lesson on time frames, we are going to expatiate on that the more. Premium and discount in a downtrend. Selling logic. You identify a downtrend, price drops, retrace upward, you wait for price to enter the premium zone, and you look for bearish confirmation, the same break of structure, candlestick patterns, and rejections at those premium zones to take trades back to the downside. So key takeaways: when Fibonacci retracement is combined with premium and discount, it creates a clear rule-based trading framework that will help you always wait for trade to materialize. So Fibonacci premium and discounts gives you a great tool for you to use when the market is trending, to look for opportunity and have the patience and discipline to wait for those opportunities to materialize. You have to look for confluences also. We're going to talk about moving average. We're going to talk about other confluences that can be used in Fibonacci premium and discount. Thank you very much. Don't forget to subscribe and like. See you on the next class.